My name is Garen Phillips. I have been teaching myself the stock market from scratch for about 7 months now and uploading videos along the way to help you learn with me. Today, we're going to talk about my day trading strategy and plan for 2018. I'm also going to be talking about day traders and some podcasts that I've been studying and watching for the past couple months that you should check out and some resources for learning. I'm going to be answering some Q&A for you guys, and also I have a discount on Ricky Gutierrez's day trading course if you're interested in that. Let's get right to it though. Day trading plan and strategy. What is it? Why do you need one? Why can't you just download Robinhood and make $1 million? If you've ever studied a professional day trader for any amount of time, you've probably heard them about having a plan or a strategy, but you might not exactly know what that is. I actually just finished the Steady Trade podcast. The Steady Trade podcast is done by Tim Bohen and Steven Johnson. Tim is a 20-year trader and the educator of UStockTrade, which is probably the most popular penny stock trading scanning software. I think it was created by Tim Sykes, but I'm not entirely sure on that. He has a ton of really good videos on the UStockTrade channel over scanning and finding stocks, so if you want to, go check that out. Steven Johnson is a 2-year day trader who is basically learning from Tim Sykes and his program, and he is doing the podcast with Tim to also learn along the way, and they do interviews and stuff with other traders, and it's a really good podcast. I highly recommend that you go check it out. But the nice thing about Steven Johnson is he actually uploads a video every single day of his trades, and not only that, he shows his spreadsheets and documentation of how he tracks his statistics. I've been trying to figure this out for like 2 months, and I have not found a single day trader that shows their spreadsheets without paying $500, $1,000 to see what they're doing. You have to buy a course or buy a DVD to do that. So props on him for doing that. Check out his YouTube channel. He shows videos every single day of his trades, and you can see how he sets up his spreadsheets as well. In fact, while I'm thinking about it, they actually made fun of me in episode 23 of the podcast. But yeah, go check out their YouTube channels, check out the Steady Trade podcast. It's on iTunes, or you can watch it on their the UStockTrade YouTube channel. But pretty much the first entire season of that is ingraining in your head how important a strategy is to have. Subscribe and like if you like their content, and leave a message or a comment if you do like it, telling them that I sent you, because it'd be awesome to be able to connect with them and learn from them. I think, based on the impression from episode 23, they don't think that I take this very seriously, but I do. I do take this very seriously, and also my YouTube channel. I plan on doing this stuff for the rest of my life. While we're on interviewing and podcasts and talking about people, I actually have a friend here in town who has, I can't tell you how much he's made because he asked me to keep that confidential, and I'm going to respect that, but he has increased his portfolio size 1,500% in over just, I think, 12 to 14 months. He started about 6 months before me and has grown his account that much. So I'm going to be going over to his house eventually and setting up my cameras and videoing and documenting his entire process and what he trades and how he does it, and interviewing him. So that's a video that I'm really looking forward to in the future. So stay tuned for that. And if you're new here, subscribe, because I'm going to be producing more content. And just to give you an idea, 1,500% would look something like this. $1,000 would be 15K, $5,000 would be 75K, $10,000 if you started with that, it would be $150,000 by now. So quite a big increase from there. Anyways, back to the trading plan. I'm actually going to be practicing and working on 3 different strategies and plans. And I know professional traders are going to tell me not to do this because you should stick to one pattern starting out, but I'll get to why I'm doing this in a little bit instead of just one, but it's basically just a long-term strategy because I plan on doing this for the rest of my life. A trading plan basically looks like this. Mine has 7 parts, yours might have more or less, but this is what it looks like. Rules is basically like, don't trade the first 10 minutes of the stock market open, don't trade a pattern you don't know, stuff like that, simple things. Screening and scanning is basically how you find your stocks. This can be done through a scanning software like Inside Thinkorswim, or third-party software like UStockTrade or Equity Feed, or if you're more of a ETF or long-term investor, this might be a website like FinViz or ETFs.com, or if you trade OTCs, a website like Investor Hub. Patterns, this can be intraday or daily charts. Penny stock traders and day traders use both charts, but if you're more of a long-term investor, you might just use the daily charts. Basically is finding patterns that you see profitability in. There's all kinds of different patterns depending on the type of trader you are, whether you're a momentum trader or a penny stock trader, gap fill, breakout, maybe you're a short trader and you do gap and goes or high a day crashes or fade outs, stuff like that. I don't have any experience short trading, so I can't really tell you much on those. Exit and entries, I've actually put exits first on this list because I learned this from Stephen Ducks. He never enters a trade unless he knows his exit position and how much profit he can make. This is extremely important for a new trader because you don't ever want to enter into a trade that you don't know how you're going to get out of. And this can be done a couple different ways depending on, again, your style and the pattern. You can use an indicator like MACD crossovers or high RSI or stochastics, or you can be more basic like using support and resistance line or trend breaks, stuff like that. Entries, same thing, just depends on your preference, whether you want to use a study or an indicator or more of a basic bounce off resistance and support, stuff like that. Sizing and risk gain, this can be done a couple different ways. As a newbie, I would recommend just sticking with sizing by percent gain. This is really simple to do in Thinkorswim. You just click the trend line button and you draw a line. There'll be a little percent sign that pops up that tells you your percent gain or your percent loss depending on your entry. Real simple way to do it. This is how I do most of my calculations. If you're more of a long-term investor or swing trader, you can risk off of a percent of your portfolio. This is like the old school fundamental way of risking, where you only risk a certain percent of your portfolio in any one given trade. This is more for swing traders and long-term investors or momentum traders. You basically enter a trade and set your stop loss calculated based on a percent of your portfolio. If the trade is green and it keeps going, you let it run out and you make your profit. If it hits your stop loss, you stop out and that's it, and you've lost 1% or 3% or 5% of your portfolio. And then lastly is sizing with margin. This is more of an advanced way to size and do your risk. This is not something you should do as a newbie, and more than likely you probably can't because you have to have a lot of margin to do this. My friend who has increased 1,500%, he actually trades more higher cap stocks. He does, $20 up to $200. He was in an Alibaba trade, I think 2 weeks ago, before it hit the 200 mark and it bounced. I think it was like $180 per share. So in order to trade something like that and be profitable in the intraday, you have to have a large margin account and a lot of money in your account on top of that. I think he has 20 or 40 times margin with his broker. And basically the way it works is if you're trading a $100 stock, you just use your margin to buy into as many shares as you want, like 10,000 or 5,000 or 2,000 shares. This is how Warrior Trader does his trading, and you basically just enter into the trade at that position. You run your strategy, you win or lose, and then you get out, and then your margin is back into your account. This is an advanced way to trade. I would not recommend it for a newbie. And then lastly, we have documentation. Again, Steven Johnson, the only guy that I've seen on YouTube that has actually shown his spreadsheets. So I'm going to be basing my documentation off of his, with some modifications, obviously, because my strategy is going to be different because I'm doing long trading and he's a short trader. But this is probably the most important part of a trading strategy. If you don't document your progress and your win to loss and your percent win, your average percent win and your average percent loss, you don't really know where you're at as far as statistics and how good you are as a trader and whether your strategy will become profitable over the long run of many months or years. And also it allows you to improve your strategy and get better with the trades that you're going in. So why do all this? It seems like an awful lot of work or very repetitive. Well, the main reason is that it helps minimize psychological risk when you're trading, like getting stopped out too quickly because of fear, or averaging down on a losing trade, or holding the bag, fear of missing out on a trade by entering too early or too quickly, making too many trades, and or gambler's mentality. All of these things are patterns of behavior that you might have brought in from past experiences in your life. Having a plan also holds you accountable for your trades and allows you to improve and minimize and maximize your strategy over the long run so that you can become more profitable. I've talked about this before in some of my other videos, but I look at having a strategy and a plan a lot like teaching somebody how to lift at the gym for the first time. Whenever I train somebody at the gym, the first thing that I ever teach them is form. You don't want to go into the gym as a newbie and just start cranking out weights without knowing what you're doing. I actually have them sit down and watch a few videos over one specific lift in the first time, and then I have them do that exact lift multiple times every day for a week so that they can get the form down. And whenever you start a new behavior or a new thing in life, your mind doesn't really know what to do with it. It can pull on past history and related experiences to kind of just figure it out. But when you are doing something brand new from the start, it's extremely important that you do it right and correctly the first time, every time, and day in and day out. This ties in with lifting weights at the gym, is form. Form is the most important thing. It is writing the muscle memory into your mind to do an action the same way every single time, no matter what. And if you screw this up, if you screw form up in the gym, it can take anywhere from 6,000 to 15,000 conscious repetitions to rewrite the neurons in your brain to get it correctly. This is how muscle memory works, gambler's addiction. Addiction in itself is how it works, and the actual biochemical process is called myelin sheathing, and it's basically a chemical that wraps itself around your neurons, and the more it wraps itself around the neuron, the more ingrained it gets into your brain, and the faster the signal speed goes, so you can do it quicker and quicker and quicker. This is basically how you learn anything in life, from the time you're a baby learning to walk, and you're all wobbly and stuff, but eventually you get it. That's the myelin wrapping itself around your neurons and your synapses to improve that activity so that it becomes autonomic and you don't even have to think about it anymore. And you see this in everything in life, any kind of profession or thing that you're wanting to do, a basketball player, a baseball player, race car driver, any kind of high speed, high activity thing, is all based around this kind of biochemistry. So with day trading, it's extremely important that you don't form habits in the beginning and instead work on your form, or in this case, a strategy and a plan that you do each and every time, no matter what. And it's better to start with small sizes if you have fear of like losing money and stuff, or even just $1, to get used to and comfortable with the pattern and the behavior so that it ingrains itself into you, and then it becomes easier to do. And eventually you turn into Stephen Ducks, who's a robot, and you just trade the exact same thing every single time, and it's no longer an issue. Over the long run, it'll also be less mentally taxing for you to do these strategies and plans. And that's also, this explanation is why I have 3 strategies instead of just one, because while it might be a little overwhelming starting out, over the long run, these strategies will get easier and easier for me to execute until it's kind of just autonomic and I just know what to do. I've done it so many times that it's easy. So that's one of the reasons why I have 3 strategies instead of one, which we'll get to in a minute. This is also no different than Pavlovian response triggering. There's a stimulus, a trigger, and you have a response. So if you want to learn more about that, check out the psychology on Pavlov. This is also called response conditioning. And if you want to learn more about the psychology of the stock market, check out the book that I've recommended a few times called Market Mind Games. It's a fantastic book that one of the first ones I read getting into the stock market, and it really kind of changed the entire way that I look at the stock market. I thought it was totally different than what it is. It's very much a psychological game, not just interpersonal, but also thinking about what other people are thinking about and looking at a stock. And there'll be a link in the description for that book. But let's get to my 3 strategies. Real quick, disclaimer, I'm not a professional trader nor a financial advisor or a investment advisor. I'm just a dude who's learning the stock market from scratch and documenting my progress of what I've learned and sharing with you resources so that you can learn with me. I am not yet profitable in any of my brokerage accounts. I am starting to turn green, but none of these videos are investment advice, nor should you buy any of the ETFs or stocks that we're going to be talking about. The strategies I'm about to share with you, while I have backtested them with some degree of success, they have not been tested in real life, which is a totally different game. Past performance does not indicate future returns in the stock market. Again, I'm just a guy learning the stock market and sharing with you what I've learned. You should always do your own due diligence, have your own strategy and plans to go in place when trading stocks or ETFs. before you ever enter into any trade. With that said, let's get to the first strategy. The three strategies I'm going to be doing is a long-term strategy based on index and ETF trading, swing trading. And my second strategy is going to be a more medium-term swing trading strategy that'll only be a few days, and then a intraday day trading strategy. The main reason I've got three strategies instead of one is actually influenced by a book that I read called, it's just general financial advice. It's called Rich Dad, Poor Dad. I think it's got like 20,000 reviews on Amazon or something like that. It's one of the best-selling financial advice books of all time. It really kind of changed the way I look at money. It's a fantastic book if you want to check it out. Again, link in the description. But basically it taught me that you never want to have your money sitting still. Money sitting in the bank or sitting in your brokerage account is not money that is effectively utilized to make more money. And while you might be a day trader and you might use that money for the first couple hours of the stock market open, the rest of the day is just sitting there. And if you have a margin account, you can use this money to have longer term trades and swing trades. So my plan is to always have my money making me money no matter what. For example, the long-term strategy that I'm going to be working on is actually based on a guy named Khoo. I think he's from Singapore or Malaysia. I'm not sure where he's from, but he focuses on Asian markets and emerging market ETFs. The reason for this is any kind of country that is industrializing or growing has a greater potential for growth when it comes to indexes and ETFs, stuff like that. And to clarify, the patterns I'm looking for these strategies look something like this. The long-term growth strategy is basically any kind of index or ETF or stock that's going straight up. I'm probably going to stay away from stocks starting out because you have things like earnings reports and stuff that can drop the price. ETFs based on indexes, specifically growth indexes like the S&P 500 or the Dow Jones or the China FTSE 50 or 100 or 300 or any kind of high market cap index, they pretty much all just go straight up unless we're in a bear market. In that case, you trade the inverse ETF. This is a very slow style of trading. It's entirely a daily chart strategy. I don't really care what's happening intraday. I'm gonna basically just play off the daily chart. And these stocks might take an entire month to run their course before you exit your strategy. What this does is allows you to effectively utilize your money to make money, but you don't invest a whole lot of time into it. You just check your position 3 or 5 times a day. It takes 5 minutes, if that, to check it. I can't really effectively utilize it right now because I don't have a margin account. I'm going to probably wait until I get profitable with the swing trading and the intraday trading, but I'm going to be practicing this strategy nonetheless. The way ETFs and indexes work is an index is either an average of a bunch of companies in a market, and it kind of shows the overall health and quality of the market. This strategy is purely focusing on what I call growth indexes or market cap indexes. This is not a strategy for commodity ETFs or any kind of resource ETF like JNUG or JDST or UGAZ or DGAZ, any kind of oil ETF stuff, anything that ranges, that goes up and down. This is not a strategy you want to use on that because of something called beta slippage. Also, without getting into the math of it, beta slippage is basically the decay of an ETF on any 2 times or 3 times ETF. Starting out, since I don't have a lot of money in my brokerage accounts, nor do I have margin, I have to stick to trading this strategy on 3 times ETFs or 2 times ETFs. And because of that, they are susceptible to beta decay or beta slippage, which is the decay of a ETF over time. You can look into it. There will be a link in the description over how it works mathematically, but it is basically a very big risk when going into ETFs like this. And for that reason, you want to stay away from any ETF that ranges a lot, which commodities do. Gold and silver prices are always all over the place. Same with oil or natural gas. You want to stay out of a trade or away from ETFs that are high leverage when there's a lot of volatility in the market, because beta slippage is amplified with volatility. So what we're looking for is any index ETF that pretty much just climbs straight up, that doesn't range a lot. It doesn't have tons of high and lows, and it doesn't have a lot of volatility. That will minimize the risk of beta slippage. And also expense ratio. The longer you hold a ETF, especially leveraged ETFs, you are susceptible to what's called expense ratio, which is it's actually a compounding calculation that is based off of the yearly cost of running this ETF. There's companies that own these ETFs and invest in them, and it costs money to run the ETF. And some ETFs can be as low as 0.5 or 0.05 expense ratio, but some of them can be up all the way to 10%. And you really make sure you look into the expense ratio on any ETF before you plan on trading it for a long period of time. The calculation is more of like credit cards and APR over an annual compounding interest, but we're not going to get into the math of that. The way an ETF works is it's basically a derivative of the index. Kind of think of an index like an apple, and an ETF is apple juice. It's a derivative of the index. It is attached to and it follows the index, so if the index goes up, so does the ETF. Examples of these ETFs would be like UPRO, which is a S&P 500 ETF. I think the UPRO S&P 500 ETF has gone up 74% in 2017 to 2018. Some other ones are SPXL, which is another S&P 500 2 times leverage, which has grown 64%. You might wonder, why has it grown less than the UPRO if it is 2 times ETF? Again, that's because of beta slippage. Even though these are growing, they are susceptible to beta slippage. I'm probably going to stick to 1 times leverage ETFs in the US market. You can make more money in emerging markets and China markets and any kind of Asian market, because those indexes which track companies in those countries are growing rapidly. I think this is more fundamental investing style, but I think China has over 1 billion people in their country. America has 300 to 350 million, but China's GDP is about the same as ours right now, which means they have the potential to grow 3 times what America has right now, because they haven't fully industrialized. Not all of their population has, gone to the industrialization or the information age yet. So they have a ton of room for growth, and because of that, you can sometimes get higher percent returns on some of these indexes versus a already industrialized, developed country like the US or Europe, which have been around for almost 100 years now. Another ETF is SPUU, which has grown 32%, and it's a 2 times leverage. Again, beta slippage causes this decay. You can also do the Dow Jones Industrial Average, which is DDDM, the TQQQ, which is the NASDAQ 100 index. I think it's one of the oldest ETFs actually. Or you can trade the China and emerging market ETFs, like the Ultra FTSE China 25 ETF, which is XPP. This tracks the top 25 companies in China, and it has a growth of 98% in 2017. So you can see that they grow a little bit more than the American counterparts. You can trade ChadU, which is a 2 times leverage ETF, and it tracks the top 300 CSI companies. It's grown 74% in the past year. And the second highest growth ETF of 2017, I believe, is Yin, which is a 3 times bull ETF that tracks the FTSE top 50 companies in China. It's grown 142% in 2017. And lastly, the highest growing ETF that I could find for emerging markets or ETFs is CWEB, which is a 2 times bull ETF that tracks the top internet companies in China. This is like companies like Alibaba, or I don't really know any other Chinese internet companies, but it has grown 150% in the past year. I've actually learned this strategy and been developing it off of a guy named Khoo. He has a lot of fantastic videos on his YouTube channel. I think he's native to Singapore, I'm not entirely sure, but he focuses on Asian ETFs and markets and emerging markets. I've gotten into contact with his team, and I'm trying to see if I can get into his trading platform and do a review video over it. When we talk about my swing trading strategy, we'll get to Ricky Gutierrez's day trading course, and I'm going to be doing a review over that. But I think I'm probably just going to buy a whole bunch of courses and go through them and do review videos over them, so that you, learning the stock market from scratch like I was, you'll have a better idea of what strategies you should go for. For example, this strategy is more geared towards somebody that's super busy. Like if you're not able to wake up every day at 8 a.m. and trade and study the stock market till 11 p.m. or 11 a.m. which is the prime time to do day trading. If you've got a day job or you just can't dedicate that amount of time to learning the stock market, a strategy like this and Adam Khoo's way of trading would be much more beneficial for you, because you don't have to be up at 9:30 in the morning to trade it. It can be something that you just check every few times a day. Now, this is still a trading strategy. This is not a buy and hold strategy, which is, you know, classic basic investment. This is actually, let me just show you what it looks like. So this is XPXL, which is the 3 times bull ETF of the S&P 500. The software that I'm using here is actually called TradeView. It's a web-based trading platform. I find it very useful for certain things compared to Thinkorswim. This strategy is basically just going to be buying dips off of a support line or a resistance line, and then riding the trend up until it reverses. I'll make a dedicated video on how I'm going to be trading these strategies, but the simple overview is I've got a 40 whole move average, which is the blue ribbon and the black ribbon, and I've got a 150 whole move average ribbon, which is the green and red ribbon. Whole move averages are basically fast move averages. They're designed for momentum. They are not a crossover strategy. They're not supposed to be used as a crossover strategy. They're specifically just to show the trend in the market over a given amount of time. They're a very fast average just to tell you which way the market's going overall, and it can be very useful when you use 2 of them together or 3 of them together. The next indicator that I'm using is stochastic RSI. This is basically 2 move averages that go together that are incorporated with the RSI, so it shows whether the stock is overbought or oversold, and it also will show momentum flips when the stochastic lines cross. This is a good indicator for buying the dips. Now, I'm only going to be using the stochastic starting out as a entry position. I don't really care about it once I'm in position. I'm going to use other indicators for the exit strategy. And again, a disclaimer, I haven't only back tested these strategies. I'll make a video on how I back tested them and how you can figure out your own strategy and how you want to test it. The next indicator I'm using is CCI, which is called Commodity Channel Index. While it's called commodities, it's actually just a momentum indicator. The one I'm using actually is modified. The nice thing about TradeView is they have a list of public indicators that people create themselves, and they rate them and rank them, and there's higher rated ones and lower rated ones. And what's nice about this is, again with Market Mind Games, that book that I was talking about, a lot of the stock market is psychology and thinking about what other people are thinking about, and also using the studies that a lot of other people use. If you've got 1,000 people all using the same study, that creates consistency in the market so that the patterns play out the same every time. So the more people using a indicator, the more likely it is you're going to see a pattern fall out of that indicator. For example, the 50 and the 200 EMA, I've talked about this before. Those are probably the 2 most important indicators you could possibly use. I think they're probably the oldest indicators ever used too, other than candlesticks, which date back to the Chinese way back when. But whenever you get a 50 and a 200 cross or a pinch, there's always going to be movement, and that's because so many people use those indicators. The way the CCI works though, basically when the line is green and above the move average, it indicates a bullish trend pattern. It doesn't tell you any kind of flip or switch, although converging and merging will kind of indicate that, but it's mostly just used to tell you the direction of the trend and how powerful that direction is. When it's really overextended, green line to yellow line, that means a very strong bullish signal. The flip, when the red is below, it's a very strong bearish signal. And the last momentum indicator I'm going to be using is the ADX with DI. ADX is basically the black line and the black dotted line. It shows potential for movement. It can show trend movement, but it basically tells you whether the stock is underpriced or overpriced and the potential for it to break out. When the black line is below the dotted line, it's got a lot of potential to go bullish, and when it's indicating upwards, it means that you've got a trend upwards. And then when it gets really high on the other side, it's basically getting ready to short and go reverse and come back down. The DI is also a nice indicator that goes with the ADX, and it's the green and red line. When the green line is above the red line, that's indicating bullish, and it's a crossover strategy. And the more it converges out and away from each other, the more bullish the indication is. When they start to converge on each other, that indicates that the trend is about to reverse. So all of these, the whole move average, the ADX, the CCI, and the stochastics are all used to enter the strategy and follow the trend up until it reverses. I'm also going to be using basic, candlestick patterns, dojis, and hammers and stuff like that. And then lastly, I have SAR parabolic, which is, I'm only going to be using it for support and resistance lines, where to buy in and buy out, and potential trend reversals. It basically just is a complementary indicator for the other ones. It's not one you would just use on its own. None of these indicators you would use just solely. It's using all of them in conjunction to get a signal of whether it's a strong bullish movement or bearish movement. And then lastly, I have the 50 and the 200 EMA. I'm always going to have the 250 no matter what, just to show potential resistance lines and bounces. And some other indicators that you can use for momentum strategies are the TTM squeeze, Mace D is a very popular one, or Heikin-Ashi candles. And again, I will be making a video dedicated onto how I'm going to be trading these and how I back tested them as well. And I'm currently in contact with Adam Khoo and his team, trying to line out getting into his course and possibly getting a discount for you guys, for those that would be interested in it. Yeah, if I have done that, there'll be a link in the description for it. If it's not there, then I haven't gotten a discount. Two other indicators that I'm looking for that aren't really technical indicators, they're more fundamental indicators, is the overall PE of the country. There's a website called CIEC-data.com, which basically shows a whole bunch of fundamental stat tracking for emerging markets and Asian countries. The main one I'm looking for right now is the PE ratios of the countries. Typically anything over 20 is overbought and anything under 15 is underbought, kind of like RSI really. For example, the stock market pullback of February, back 2 weeks ago, I think, when the Dow Jones dropped like 900 points. I think China's PE ratio was somewhere around 20 when the crash happened, so I don't know what it's at now, but obviously it's pulled back. So PE can be a good way to tell you fundamentally if some of these markets or indexes or ETFs are overbought or oversold in the overall market. And another one is the US 2 to 10 year bond yield spread. This is kind of complicated for this video, but basically it's a ratio of the interest rate of a 2-year bond from the US government and a 10-year bond of the US government. And so far, for the past couple of recessions in black markets of the 80s and the dot-com crash and the 2008 housing market crash, anytime the 2 to 10 year spread goes below zero, there's been a crash in the market. So some people argue that this can be a good indication of a potential major pullback in the overall market and indexes. So that's another thing to look for. Again, I haven't really gotten into his course. I've only been watching his free YouTube videos. I'll actually make a playlist for those that are more interested in this style of trading, and I'll put it in a link below of the best videos I found on his YouTube channel. And let him know in some comments that I sent you to his channel. As for rules for this strategy, basically try to stay out of the markets when there's a lot of volatility. Keep your stop losses tight because this is a momentum strategy. If it goes reverse, it might go reverse for quite a while. For screening and scanning, I'm going to be doing it a few different ways. I figured out a way to screen and scan for ETFs on Thinkorswim. I'll be doing a video over that entire process because it's a little complicated. But also ETFs.com, which basically has all kinds of different, ways to scan and screen for stocks and the highest percent gains, and you can do emerging markets or China-based ETFs or other companies. For patterns, we've already discussed this. I'm looking for stocks that are going straight up with low volatility, steady climbers with minor pullbacks. Obviously, you need some pullbacks to get into the market on a trade, and you can also trade these patterns a lot of different ways. You can just buy and hold for the long run until you get like a 50 EMA cross or 150 whole move average turns, or you can play the individual pullbacks, and it's selling at the high point and then waiting for the pullback. There's ways to figure out if there's an indication of an overbought or oversold with the individual moves throughout the day. So depending on how you want to play it, what type of time you want to invest into the trade, there's a lot of different ways to do it. Entry, we've already talked about this. I'm looking for pullbacks, low RSI, good indications on the AXD and the DI, also minor movement on the CCI, stuff like that, using the SAR parabolic dots to set stop losses and entry points, and also candlesticks that will indicate a bullish or bearish action, which we won't get into candlestick patterns in this video. Actually, I'll have a link in the description of a fantastic video over 12 candlestick patterns by a guy called Mark Bigalow. I can't remember his name, but he's like a 30-year day trader. He's an old school, 1980s candlestick pattern trader. But he knows candlesticks very well, and it was a very good video. As for sizing and risk with this strategy, again, we've talked about this. Beta slippage with 2x and 3x ETFs is a major factor. High volatility is bad, and high expense ratio on the overall markets is also bad. The lower the expense ratio, the more volatile you might get into stocks. Like, you can apply this to India or Brazil or Hong Kong or Singapore indexes, but those might be a little more ranging. They won't be as stable as an S&P 500 or the yen, which tracks the top companies in China, or the CWEB, which is internet companies in China. And the last big risk of this strategy is low daily volume. We haven't really talked about this, but you want to make sure that these ETFs have volume. You don't want to get stuck in them if you have a major downturn like the pullback of 2 weeks ago. And lastly, documentation. I'm going to be creating spreadsheets. I'll be doing a video over this specifically because this video is already getting very long, but documenting all my trades and the performance on wins to losses, and I'll be doing a video over back testing and how you can figure your win to loss and your win percentage and stuff like that. Very, very important, especially for a strategy like this. All right, now for my medium-term swing trading strategy. A lot of the parameters are kind of the total opposite of the long-term trading strategy. I'm currently basing this strategy off of Ricky Gutierrez's ETF swing trading strategy and intraday strategy. For those that are interested in getting into his trading course, it's currently $300, but I've got a $25 discount for you. Just enter the promotion code Garen on it and you'll be able to get in with a discount. But his strategy is a very straightforward strategy for swing trading. Basically, he trades off of the 4-hour chart, and he looks for commodity and sector ETFs that are ranging. And again, this is different than the growth index. We're looking for stocks that are moving a lot. Now, they're going to be much more susceptible to beta decay, a lot more volatile, so the trades are going to be much shorter in duration. We're talking 1 or 2 days, week max, maybe 2 weeks if it's crazy, but more than likely it'll be shorter than a week. And again, this is going to be a little bit more time investment to do these. You're going to have to manage them more throughout the day than you would the long-term growth strategy. You're going to want to look at the intraday stuff. You're going to have support and resistance lines, stuff like that. You're going to, but the overall strategy is basically looking for ETFs that are hitting their lows and also gap up above their 8-move average or 9-move average, which is the main way Ricky uses a signal to find a stock that is starting to move up and reverse its trend. Now, one of the common things that you'll see a lot of these ETFs do is they'll actually come down and then consolidate for a little bit before they either reverse or continue downwards. So you can be sitting for multiple days before you actually get an entry signal into these stocks. So there's much more patience involved with these ones. You have to wait and really find a good setup. I'll be doing, when I do my video over scanning for ETFs on Thinkorswim, I'll try to show some different ways you can find a ETF that's hitting its lows or breaking out on a high or something like that. But that'll be a video for another day. This one's, again, pretty long already. Stocks like this, again, are sector or commodity ETFs, ones that are ranging and moving a lot, but again, they'll be decaying. JNUG, JDST, USLV, UGAS, DGAS, which is natural gas, OLU, which is oil, any kind of stock or any kind of ETF that is attached to an index or commodity that is moving a lot. Gold and silver, they're always fluctuating, they're always all over the place, and so is natural gas and oil. So because of that, these ETFs will move a lot. But again, the more movement they have, the more decay you have. So the overall trend is usually bearish. Now, I might adapt some of the indicators from the long-term growth strategy into this strategy for swing trading, but I'm still going through Ricky Gutierrez's course, and I'll eventually be doing a review video over that course. So for those of you who want to learn about it or think that it might be for you, I'll give you some insight into what it looks like and what you'll get out of it and the quality and content that is presented into it. But yeah, it's a pretty straightforward and simple strategy. You're basically just looking for support and resistance lines, gap ups above the 9 EMA. You'll be using the 50 and the 202 as well for bounces and rebound plays or pinches. But that's pretty much it. It's a very straightforward strategy. And lastly, my intraday day trading strategy. I haven't quite lined out what pattern that I want to trade with. I have studied quite a few different traders. I was in Decay Trades, which is a trading chat room, and he is a sub penny stock, below $10 trader. Sometimes he gets into higher stocks, but mostly he trades the lower cap stocks. And I learned quite a few patterns from him, like a gap fill or high day breakout. There's certain momentum strategies you can do intraday, or news trades, but I really haven't found the pattern that I really like yet. And I also haven't done much back testing on these patterns. The market actually just changed the past 2 weeks with the pullback of Monday in February, where the Dow dropped 900 points. The market just kind of shifted. There's a lot more volatility overall, so I don't really know what patterns are the solid ones to be trading right now. Eventually, I'm going to be buying Steve Dux's DVD. I'll do a review video over that as well. I'm really interested in seeing his spreadsheets and the most profitable, consistent patterns that he sees, because he said in interviews that he's done thousands of spreadsheets, and the benefit of getting that DVD will be I'll know what patterns are the most consistent and the most profitable. So far, gap fills seem to be the most profitable, especially when news comes out on them, because you have a set resistance line and support line. They almost always bounce off the 200 EMA or the previous resistance line when they were gapped down. It's a very solid, simple strategy. You know your risk and reward. The risk stop loss is always below the consolidation period, which is usually very small on these gap down, gap fill patterns. You can also get into higher float stocks that are more momentum. They just kind of run up through the entire day, but it's much more harder, and you got to monitor those throughout the entire day. It's a lot of consistency and paying attention to it. Another strategy that could possibly be used for intraday is ETF ranging, playing off the VWAP. This is something that Ricky Gutierrez does a lot. He'll trade UGAZ and JNUG and JDST or Nugget, and basically he just looks for bounces on the VWAP. He buys in and then runs it up to the mid VWAP, or if it breaks more, it goes all the way up to the top of the VWAP, and then he sells out. And for a small account, this is not very profitable, because you're only talking about 3 to 5% at the most for some of these 3x ETFs. But when you start to get more money in your account, where you get margin and you're more proficient with your trades and your strategy, you can do what we said earlier with sizing, where you size off of position and margin, where if the average movement of, say, UGAZ is only 3% a day, you can size up your position twice with leverage so that your profit will be 6%, or 3 times, which will be 12%, so on and so forth. Now, this is also much more risky. You want to hold your stop losses much quicker, much tighter, because with a smaller account, you can blow up your account. This is not a strategy that you would use for a novice or beginner. This is not what I'm going to be doing starting out, because my accounts are too small. My strategies are not lined out. I don't know my accuracy or my win rates, my percents, wins and losses, stuff like that. Don't do this style as a novice. But the benefit, long run, doing this strategy is if you get very proficient at it and good at it, you can just size up and size up and size up on these ETFs and grow your account much more consistently, because you'll start to learn each ETF individually. If you're trading just UGAZ and DGAZ, or just JNUG or JDST, you start to see very similar intraday patterns. You know how they act, you know how they behave. This can be more difficult with a penny stock, because penny stocks change with the market. There's different patterns that work different parts of the year. There's really hot times in the month for penny stocks, and there's really slow months for the year. With a ETF, it's kind of the same thing every single day. You you always have them moving. So it's more just preference, style, how you want to do it. Again, I haven't chosen really the strategy that I want to use intraday. I want to get into Tim Sykes's Profitly website and his penny stocking silver program, which has thousands of videos over day trading. For those that don't know, Tim Sykes is a 20-year penny stock trader. He started in 2000 in the dot-com boom. He's made millions of dollars on it. He has made more millionaire students than any other day trader out there currently. Warrior Trader is, probably close to a second to Tim Sykes, but inside Tim Sykes' website Profitly, you also get to communicate and interact with all of his students, which is a very beneficial thing that I want to check out. You can follow people like Steve Dux and Tim Grittani and Michael Good. Steven Johnson is also in there. I think Tim Bohen from Steady Trade Podcast is also in there. A lot of those big name day traders are in Tim Sykes' Profitly and penny stocking silver. So I would prefer to try to get into that. Also, for those that are brand new to trading, I would check out Decmar Trades, Connor Portfolione. Ricky Gutierrez is also a solid course for the beginners. Another guy that I just started recently running across is Tony Ivanov. He's a younger kid, but he specializes in penny stocks. He knows the patterns and the gaps and stuff like that. He is much more like Tim Sykes or Decmar Trades. I don't know what his cost is on his trading chat room and platform and what it is exactly, but most of those guys range anywhere from $100 or less. I think Connor's is around $30 right now. Last I checked, Decmar's was $60. You can also get into a higher priced news trading chat room like Awesome Calls. I've not been in there, but my friend who has grown his account 1,500%, he was in Awesome Calls for a while. I don't know if he's still in it, but he said it was an awesome chat room. I can't say from firsthand because I haven't been in it, but yeah, I'm still on the fence with my intraday strategy and trying to line it out. So as I figure that out, I'll be making more videos showing exactly what I'm doing. Oh, and lastly, two other trading courses or platforms that you can do is Eat, Sleep, Profit. Again, my friend actually was personally trained by, I think his name's Tony, who runs Eat, Sleep, Profit. He's a solid guy. He doesn't make a whole lot of YouTube videos, but the ones that he does have out are fantastic. Go check out his YouTube channel, Eat, Sleep, Profit. And the Bullish Bears community. They have a lot of really good videos on their YouTube channel. I haven't really checked out their trading chat room or what they do, but they're also a very solid trading group. All right, I will end this video with some Q&A, and if you like this video, please share it and subscribe or put it on Facebook, whatever. I need some water. I feel like I've been talking for an hour. Yeah, if you like this video, please share it and try to get it out there on the net. I'm pretty much inspired to make these videos because the first one blew up and you guys started really liking it and saying that how much it helped you. I've gotten a ton of comments and messages and emails and Instagram DMs on like questions and people telling me that my video got them started down the track of trading, which has kind of inspired me to continue to go and push myself and learn. This video, none of these videos have been intended to be a proof of that I'm a successful trader or I'm trying to bullshit you or sell a course. I'm not any of those things. I don't plan on selling a course or doing anything like that. I will promote good traders and good chat rooms that I see benefit in, that people might learn in. I want to kind of position myself more as a reviewer and basically just pointing people in the direction of professional traders that they could learn off of. And that totally depends on you. That depends on how busy you are in your life, like the responsibilities and stuff you have to pay for. If you've got a house and kids, obviously your trading style is going to be much more restricted and different than a 19-year-old kid who mostly sits at home all day and plays video games. So it depends on who you are and the time you have to invest on what kind of strategy you want to get into. If you are very busy like I am, I would stick more to a longer term strategy like Adam Khoo or ETF investing, swing trading, Ricky Gutierrez's style. That will be a much more profitable and time efficient way to trade, because if you want to be a penny stock trader, you can do it, but I've been studying for 7 months now, probably averaged 4 to 8 hours a day. This past 3 weeks, 12 hours every single day, even on the weekends, and I'm still not profitable on penny stocks. It's a very competitive and highly volatile market, and you got to learn a lot of stuff for penny stocks. ETFs and long-term swing trading, investing, and stuff like that, much more straightforward, much slower. The movements are much slower, which allows you to make more mistakes and cut your losses quicker. Some of you have been asking the software or the brokerages that I use. I'm currently using Thinkorswim for my main scanning and intraday stuff. I've recently been checking out TradingView. I think it's a pretty awesome platform, especially the community studies and stuff like that, learning off of other people and finding things like that. It's very interesting that they've incorporated that into their, as far as scanning, mostly Thinkorswim. I would like to get into a platform like Stocks2Trade or maybe Equity Feed, but I've seen more people interested in Stocks2Trade. And also, the more that you share these videos, the more I will be able to interact and network with other traders, which means I can interview them and make videos over them, which will help you learn, because that's also one of the main reasons I started doing these videos, is I wanted to connect with other day traders and learn from them and make videos over them and do interviews and maybe a podcast or something. So that's something down the road. But if you like these videos, please share them because it helps me out tremendously. For those of you that do have questions for me, I get a ton of YouTube comments and it's very hard to sift through them all. If you have questions, send them to my Instagram. Link in the description, just Garen Phillips on Instagram. I try to answer them all through Instagram. It's my most used social media, and it's just the easiest for me to do it. Some of you have been asking what brokerage I'm using. Currently, I'm using UStockTrade and Robinhood for different strategies. UStockTrade is based outside of the US, so it's not subjected to the PDT rule. Unfortunately, it doesn't have margin, and you can't trade OCT stocks, so it's there's some downsides to it, but it's $1 per trade, so that's $2 for entry and exit, and then $1 per month. I found it to be a very good, much better platform than Robinhood for day trading, especially for those quick intraday stuff. And then I'm using Robinhood for testing my long-term and swing trading strategy, just because it's free, and a lot of times I'm holding these stocks for more than a day, so I'm not subjected to the PDT rule. And once I put more money into it, I'll start margining it up and using more leverage and stuff like that. Long-term, once I grow my account to $10,000, I plan on probably getting Interactive Brokers, which has been a very highly rated and suggested brokerage firm. I think the minimum is $10,000 unless you're a student or something, and then I think it's like $3,000. I'm not a student, so unfortunately I can't do that. I might be wrong. I need to check more on that, but it has been a very highly rated brokerage firm. And I think, I can't recall exactly, but my friend who has like the 20 times margin or the 40 times margin, he uses, I think, TradeNet. I'm not entirely sure on that, but you know, long term, I'm going to be looking at better brokerages with better leverage, better transaction fees, stuff like that. And especially when I start to grow all three of these strategies in conjunction, and I basically start using the margin, each margin times one will be used as another position size in the longer run ETFs for my growth strategy. For example, right now, I can only really enter one stock or one ETF like the SPXL or the CWEB at a time, but as I get more leverage, I can then enter into more trades, so that while starting out you're only making 20% over a week or a month, when you've got 6 positions or 10 positions open on different ETFs in different various indexes, you're talking about a lot of money accumulating over time that is very low maintenance. It doesn't take a lot of time for these to manage these strategies. So while it's going to be a lot of work up front in investing, over the long run, months, years at a time, when I'm 40 or 50 years old, these strategies will be very applicable when I've got a lot of money and leverage to use and I'm proficient at my straight trades. Another question I get a lot is, what do you do if you don't have a lot of money getting into the stock market as a newbie? Do not trade. Don't spend your money on trading, because you're going to blow it up. 90% of traders blow up the first account. You're going to lose it. Your money is better spent educating yourself. Get into a trading course or a chat room. Learn from a professional. Learn from somebody that knows what they're doing. Read some books. Watch tons and tons of videos. Don't waste your money, because you're going to lose it. I thought that I could figure it out quickly, and your money is better spent just holding it and learning. Figure out a pattern, figure out a strategy that you like, that you relate to, that fits your lifestyle, and then go from there and start trading small amounts. I tell people, if you can take $1 and turn it into $2. You can take $10,000 and turn it into $20,000. The percent is what is important. Your percent win, your percent loss overall, and your accuracy for each trade is what is going to make you profitable in the long run. That's why I just spent like an hour making a video over trading strategy, because that is how you become profitable in the stock market. If you aren't doing some of the things that I've talked about, making a strategy stuff, you're kind of just guessing. You're hoping for the best. You're one step above a gambler, but you're still a speculator, basically. You can get good with it with enough experience, but it's probably going to cost you a lot of money, and you can refine your strategy and accuracy and win percent much quicker using a strategy, doing it day in and day out, staying consistent with one pattern. And that's my second suggestion that I've seen from a lot of professional traders. Do not try to do a bunch of different patterns. Don't try, if you want to do just day trading, don't try to play every single type of day trade. Don't do gap and fills and breakouts and momentum trades and try to short trade as well. Stick to one pattern starting out, perfect it, get really good at it, then add a second one. This is probably the biggest mistake that most newbie traders make. The most important thing in the Steady Trade podcast, a lot of professional traders talk about it, to stick to one pattern only. And then as you get more proficient with that pattern and you start tracking your accuracy and your win-losses, then start sizing up. That's when you start adding money to your positions and you start actually growing your account. Before you get to that point, do not trade. I have basically just been messing around for the past couple months. I've been educating myself, trying to learn as much as I can. I will enter into trades with small positions just to get an idea of my efficiency at trading and basically just tracking my stats. And then as you do it more, then size up and you will start making money and growing your account. I think that's about it. Again, the coupon for Ricky's trading course is Garen. Go ahead and check it out if you want. I'll be doing a review video over that soon. I'm also gonna be doing a video interviewing my friend and showing his trading style. And I'll be doing more dedicated videos onto the specific entering and exiting of the strategies that I've just talked about, and showing you how I back tested these strategies so that you can back test your own and perfect your own and start tracking your own stats. Hope you guys like this video.